welcome to the Simplifying Investing, everyone, and good to see you, Deanna.
Hey, Shane. How are you?
I'm pretty good. Hope you are too. You've been away somewhere. I don't know where you were. Was it holidays?
Mixture of travel. No, it hasn't been any holidays, unfortunately. And sort of been an interesting few weeks here in Australia because we've gone from talking about rate cuts, maybe even potentially one cut in December in the meeting that just passed from the Reserve Bank, and now we're talking about rate hikes. So what on earth's happening?
It's certainly been an amazing turnaround. It seemed only back in August where we were talking about 2 or 3 cuts, and that was pretty much the money market's consensus. It was factored in. Even the Reserve Bank was talking about that. And then we've progressively gone from 2 or 3 cuts to maybe 1 or 2 cuts to 1 cut to no cuts. And now, as we're speaking, the money market's talking about, or has factored in, more than 2 hikes through next year, with the first one coming as early as February potentially. To me, it just seems a little bit extreme. Yes, we did get that wacky inflation number for October. We don't even know how reliable it is, but that is the thing that caused the switch. Then we've got some strong data for domestic demand in the economy, the GDP numbers. Fair enough, they were strong. There's no doubt about that. And then we've got consumer spending numbers, household spending survey was on the strong side. So all of these things have come together. And then, of course, it was reinforced by the Reserve Bank the other day, which is, the statement that came from the Reserve I thought was fairly balanced, but it had a sort of a tightening inclination to it.
Yeah.
But I think the thing that really changed things was the press conference, where the simple message from the Reserve was that if inflation doesn't come down, then they'll have to raise rates. And the governor didn't see much scope for a rate cut in the foreseeable future. So that sort of pushed the money market, reinforced the money market. And then, of course, other economists have sort of jumped on and said, we were thinking about a hike maybe later in the year, maybe now it's going to be the middle of the year. To me, it's all run a bit too far. I don't think the economy's gone from one extreme to the other in such a short period of time. And I do worry that all this talk about rate hikes will actually start to depress things, because people with a mortgage were feeling happier that it had 3 cuts. There was talk of more to come. Now we've gone none to come, and hikes potentially reversing those 3 cuts. So I think if you were someone with a mortgage, you'd be a little bit concerned about all of this. That said, I understand where the Reserve Bank is coming from. They have to get inflation back under control.
So she actually used the comment in the press conference that the board was worried about inflation, where it was tracking right now, because the headline numbers on the latest reading for October at 3.8%. Of course, that includes some electricity prices in there. So if you exclude that, it's more like 3.3% year on year to October, and the trim mean is a little bit over 3% as well. So do you think that the board should be concerned about this rate of inflation? Like, is inflation at 3% a problem?
Well, in the great scheme of things, it's not. This is not 8% like whenever it was 3 years ago. A big difference. It's not the 9 or 10% that parts of Europe and the UK were seeing. So in that sense, I don't think it's a disaster. But I can sort of understand they probably want to do a bit of jawboning. And I kind of wonder that was part of the press conference, jawboning people to say, well, we're pretty serious about getting this down. Don't go asking for higher wages and all those sorts of things, or to companies, don't start putting your prices up aggressively. We will get it back under control. So I can sort of see where they're coming from. But the flip side, of course, is that economic data runs hot and cold. The inflation numbers run hot and cold. We saw it a year ago. Our colleague Mibu was just checking what the Reserve Bank was saying back in November, December last year. And we just had some higher inflation numbers. The Reserve Bank had actually said in November that it's hard to see a case for a rate cut in the near term. And that, of course, includes out to February. And then, of course, that was reinforced later in December, I think it was. And then, of course, we got lower inflation numbers, that we get a rate cut in February. And so these things happen. You occasionally get this. And likewise, the economic data, the consumer data, does show a pickup, but it looks very dependent on promotional activity, discounts, Black Friday, those sorts of things. And so it's unclear as to how sustained that will be, particularly if we now go into a world of talking about higher rates. So I can understand where the Reserve's coming from. It is one of their objectives. They can claim, well, maybe they're still at full employment, but inflation's above target, so maybe they've got to sound a bit tougher on that front. But I'm reasonably confident that inflation will come back down. it's not going to come straight back down to 2.5.
Yeah.
But if you get a 0.8 on trim mean in the December quarter, which we won't get for another 6 weeks or something, end of January, then I think that would be enough for the Reserve Bank to hold rates. So what do you think?
Well, our view on inflation, I think, really hinges on the labour market, which we haven't really mentioned so far. And the labour market data has been mixed, I'd say, in the last few months. The unemployment rate's been hovering between 4.3 and 4.5%, which is still pretty low for Australia. I think it's a really good outcome. I mean, that's still below where we had the unemployment rate prior to the pandemic, whereas most of the countries now have their unemployment rates above where they were before the pandemic. So it explains why other central banks are still cutting rates or have cut rates by more than Australia. But our view is that the unemployment rate isn't really headed much lower from here. If anything, it's probably going to go a little bit higher. We've had some job ads data in recent weeks, which have still been declining. I think that we've had about 5 monthly declines in the SEEK job ads. The volume of job ads or hiring intentions across other indicators, or the stock of those that we get from things like the NAB business survey, they're not really that flash. I wouldn't say that hiring activity is strong, particularly in the private sector. I think a lot of the reason why we've had the weakness in the unemployment rate is because the public sector has been employing so many more people, or maybe not directly public sector, but areas that are related to the public sector. So what you would call the non-market sector. So healthcare, education, public administration, even things like utilities or transport, where you do get a lot of public sector funding involved. And my concern is that that's not going to continue to be as strong next year. And the private sector is still relatively sluggish, apart from some increase in business investment related to AI. Residential construction isn't really that strong. The building approvals data has been pretty poor the last few months. So to me, it's hard to see the unemployment rate going down from here. So if we see softer wages growth into 2026, I think that should help services inflation as well. And I also find it hard to believe that a lot of the inflation that we've had in administered prices, which has actually accounted for the majority of the increase that we've had to inflation in the last 12 months, that is going to keep going up, because a lot of these administered price items may just be one-offs, like property rates and utility charges or medical costs. If you don't have as much private sector activity going on in the economy, and we're sort of, I wouldn't say that growth in Australia is particularly strong. I find it hard to see where that market services inflation is also going to be higher in 2026. So I do find it hard to make a case for why inflation is going to keep going up. But I suppose from the Reserve Bank's point of view, even if it just remains at current levels, it's just too high for their liking. And what's also interesting to me is why countries like the US Federal Reserve are still comfortable with core inflation running above 3%, where it is right now, and we in Australia are not. Like, the Reserve Bank seems to have no appetite for core inflation to be anywhere at 3% or above, whereas countries like the Fed, like the US are.
Well, Trump would say there's no problem and that the interest rate should be a lot lower in the US. So the Fed has actually been a lot more hawkish than their political masters have been pushing for lower rates. I kind of want someone, the Fed would say, well, we've got this uncertainty associated with the tariffs, and the rough estimate is they've added 0.7% or something to inflation. And we don't want, so we know that the 3% is higher than it should be. It should be 2%, but part of it could be tariff related, so therefore we shouldn't be too worried about it. I think that's where
the tariff evidence and the inflation figures, I don't think, is clear. Like, when you look at the categories that you'd think would be most sensitive to tariff increases, I don't think it's actually evident that we've had this inflationary increase to consumer prices, maybe for producer prices, but consumer prices have been more sheltered compared to the increase to business costs.
Companies have been bearing the cost of the tariffs, but it's an interesting one. But in the great scheme of things, if you look at the key pressure on the Fed, it's been to cut rates more, and they've been
then maybe it's the political pressure.
Well, it could be. And that's a problem ultimately for the US. And it's good in Australia we don't see that same degree of political pressure, although it may come back to some degree if the Reserve does have to act aggressively.
I just worry that we're so obsessed in Australia with reaching this inflation midpoint of 2.5% that we may see rate hikes earlier than we need to, while private sector activity is not particularly strong, and then we risk setting the economy back at a time that that activity is
And then we'll
actually in a
chase
good
our
spot.
tail, and then inflation will then come down again. So it's a difficult one. I can understand why they want to get it back to 2 to 3, 2.5. I don't know why we're suddenly so obsessed with the number 2.5.
Well, it was after the RBA review.
After the RBA review. But the RBA review had a few dodgy things in there, I think. And I always thought the RBA communication was okay, and I'm not totally convinced the press conference is a great thing. I think it leads to some confusion. And I'm not, I don't know that they needed to firm it up anymore. Like 2 to 3 seemed like a good thing, and it served us pretty well over the last 30 years. Now being obsessed with 2.5 seems a bit pedantic to some degree. But I think, the whole point with the 2 to 3 was to allow some scope to, if you're confident inflation will come back in, then you wouldn't need to react. I guess the question the Reserve Bank faces is whether they're confident enough at present to just leave it where it is, or whether they feel they need to act. Because if it starts rising from here, and trim mean is already 3.3 on the one number, or the other number, the more reliable one, the quarterly one, it's 3%. But if it keeps rising from here, then that could affect inflation expectations, and then it gets even harder to get it back down again. And then you end up with those problems we had pre the inflation targeting era. So I guess I'm probably a little bit more concerned about, yes, we got to keep it in or around that range. But I certainly don't think they need to start tightening just yet. I think or imminently. And my feeling is inflation will come back down, and therefore they'll be able to remain on hold, which is our new view through next year. RBA will be on hold.
So a period of on hold for a while at least.
Yeah, and don't forget the money markets, I think, have a problem with that. We did see rates on hold for 3 years, 2016, 17, 18, 19, from mid-2016, mid-2019. Money market, of course, is constantly changing around. Next move is going to be a hike, I think, was the constant call through that. And, of course, rates kept coming down. So there has been occasions where the money market gets it wrong. We used to do those old charts. We'd have the actual cash rate, and the money market was always expecting rates to go up from that level. It didn't happen. Now I think the money market's thinking, well, if they're not cutting, they must be hiking.
Yeah.
That seems a bit too precipitous to me. But let's move on to another thing. Social media. We've just seen the ban come in on kids up to 16 accessing various social media. You've got 2 young kids. I know my kids went through the era when the iPhones came along and they got them. But since then it's become a lot more intense. And I sort of can relate to where the government is coming from. And this was actually a coalition proposal to start with. It didn't come from Labor initially. I think it came from the coalition. So what do you think about that?
I actually support it. And to me, I guess as a market economist, you think, well, just let the market figure it out and don't intervene too much.
That's my starting point.
But I think sometimes you need to give people signalling. And this is where I think this is important. This is a signal to families and to parents that kids under 16 don't have the right mindset to access all these tools. I mean, there are some really good things on social media, like the Econocides channel.
That's right.
That we have, where we talk about economics and educational things.
By the way, anyone watching this whose kids used to access it via Instagram, Econocides that is, if they can't anymore, they can go to LinkedIn.
Yeah.
And they can still get them.
Or listen to our podcast, of course.
Listen to the podcast.
But to me, it's just that signalling that, this is not the right age for you to use these channels.
Because there is a lot of evidence, like that book by, is it Jonathan Haidt, I think, wrote a book on this. There is a lot of evidence that social media might be damaging kids at a young age.
Especially girls.
And if it's a bit like smoking. Well, back to the bigger issue, there's this thing called market failure.
Yeah.
Where my starting point is free markets are the best allocator of resources and they should be left alone. But sometimes they fail. And you could argue that, that's the argument for taxes on addictive substances like alcohol and tobacco. We get all sorts of debates about this. What are all the other addictive substances as well? Just put a tax on them. But therefore the government should intervene in some way, which is what we've done. And now I guess we're just saying the same thing with social media, that it can be addictive and it can cause problems. And therefore children's brains aren't developed enough. That's probably where I would come from, although I do have sympathy with the free speech argument. But I think ultimately...
And I'm sure kids will find a different way to talk to each other, but if that's going to each other's houses, then that's probably a better outcome than sitting on their phones in their bedrooms.
Probably right.
But let's talk about our end-of-year wrap, given that this is the last podcast for the year. So thanks to all our listeners for tuning in. So Shane, you wrote a wrap of 2025 this week. Do you want to just take us through the key highlights?
Well, just quickly, 2025 I think turned out better than I expected. There were some disappointments from our point of view, particularly on Australian inflation. We got that wrong. It came down and then it went back up again. So that's a concern. We didn't expect to be at this point in time talking about rate hikes. Definitely not. So we got that wrong. That said, at the start of the year, we were talking about a cut to 3.6% this year. So you could argue we got that bit right. And the broader picture globally, if anything, turned out less harmful. And so
I think we always tried to take a more moderate stance on tariffs when they came out.
Yeah, we sort of had this view that this could cause an upset, and we did say a year ago that at some point through the course of 2025 there would be a 15% correction in markets. Yeah. Our market did have a 14% correction. Global shares was 17, US shares was 19. So we got that. And I think a key concern was the tariffs. But ultimately, Trump put the tariffs on. Fortunately, he did at the start of the year. He put the tariffs on, and then he, depending on your interpretation, he chickened out or made deals, whatever it was. And the rest of the world said, okay, if you want to tax your citizens, whether it's corporates or American consumers, that's your fault. You go ahead and do that. But we're not going to put tariffs on our own citizens. So the rest of the world did not get into a trade war. I mean, there's a few countries that retaliated, China, Canada, but by and large, no one retaliated. So consequently, the impact was relatively minor. I guess individual industries would say it was bigger, but in a macro sense, global growth remained resilient at around 3%. Inflation, it's come down, but it is still a little bit sticky around the 3% level in many countries. So that's a bit of a concern. We did see more rate cuts though, and that's helped markets, and profit growth has been very strong. And of course, there's been lots of geopolitical events, like the war in Ukraine continues, the Middle East escalated, bombing of Iran with the US involved. But yeah, the flow onto markets was pretty minimal in the great scheme of things. So when you look at the returns, they've actually been pretty good. And I guess when you look forward, it sort of looks okay as well. You know, recession is still a risk out there, but just as we didn't have it as our base case a year ago, we don't have it as a base case now. I think, there's still rate cuts feeding through. There's some uncertainty in Australia. We think the RBA will leave rates on hold. Not as good as we used to think. We used to think they might cut more, but we think ultimately as inflation comes back, that'll head off a rate hike. But obviously there's a risk on that front. But I think the good thing about Australia is we are starting to see stronger profit growth come through as the economy picks up a notch. And I think that should underpin reasonable gains in the share market. So, yeah, you're going to get volatility. I wouldn't be at all surprised if we have another 15% correction somewhere along the way. It is the midterm election year in 2026, and they're known for volatility. But by the same token, it's hard to see what would cause a major bear market. I know a lot of people think, well, what about valuations? What about AI bubble? Yes, share markets are a bit expensive. They're not great timing tools, though. And yes, we could be going into an AI bubble, but I reckon it's still early days. When I look at the CapEx spend in the US and Australia on data centers, it's been like the last 12 months. Go back to the tech boom, that went on for almost a decade and went to much higher levels as a share of economies in Australia or in the US and to a lesser degree Australia. So that's why I think next year is probably an okay year, but yes, there will be volatility along the way.
And it may be harder to get the double-digit returns again.
Yeah, looks to me like we haven't. I know global shares have had double-digit returns in 2025, but the average for balanced funds on my calculation is a return of about 8.6%. That's at least up to November. So we could end up, 9% or something of that order, but down from 10.9%. in 2024. And I think 2026 might see another slowing, but still reasonable. Yeah, even if it comes in at 7%, that's a pretty good return when you're only getting 3.5% out of cash.
Mm. Okay, so let's do a rapid fire end of year wrap. What's one word to summarize the year?
I'd say resilience.
That was the answer that ChatGPT gave me. I would say gold. Okay, next. What was your biggest surprise of the year?
Biggest surprise of the year. How quickly share markets bounce back. My biggest surprise of the year was how quickly share markets bounce back after Liberation Day.
Mine was your day in the life video going viral, which has like 900,000 views or something crazy.
Oh, my God.
What was our most correct forecast?
That interest rates would come down.
I said the share market returns. What was our most inaccurate forecast?
That inflation would come down and stay down in Australia.
Agree, inflation. What was your favourite event of the year?
That's a good question. I know what my most depressing day was, my mother-in-law's funeral. And on that same day, you sent me a text saying that Jimmy Kimmel had been canned. I mean, that was not a good day.
So that was the worst day of the year.
That was the worst day of the year. The best day of the year, most days are happy for me. I mean, I don't have many bad days. Most days are happy.
Well, I guess not my favourite event. I couldn't really think of my favourite event, but a picture really stuck with me. It was after the productivity roundtable that Jim Chalmers had, and there was a picture of Jim Chalmers, Michelle Bullock, Danielle Wood, Jenny Wilkinson, all walking together. And I think Sarah Hunter may be in there too from the RBA. But anyways, all these female economists.
Going down to the event.
Yes, walking together, all these female economists. Basically every head of an economic institution in Australia is now headed by a female, which I thought was great.
That's impressive, yeah.
Given that we've had all these issues with girls going in to study economics.
So more girls still need to study economics, and they need to look to the example of those people.
That's right. They're just missing me from that picture, obviously.
Next year.
What was your favourite Trump quote of the year?
I'll have to paraphrase it. And there was hundreds of them. I get a laugh at them every night. But one of my favourite was he said he stopped so many wars, he's even stopped wars before they started.
That's why he'll get the Nobel Peace Prize, maybe.
He did get a Peace Prize. FIFA gave him a Peace Prize.
But not the Nobel Peace Prize.
No.
Mine was Too Late, Pal. And what was your favourite chart of the year? My
favourite chart of the year, and every year, is the one of compound interest. That goes back to 1900. As I said to me, if I go to bed with any chart, it would be that chart. Compound interest.
Mine is the chart that you put in your weekly every week of the different asset classes, gold outperforming by 60% year to date and US dollars down by 10%, just to see the difference in different asset classes this year. And that you can have wide performance even in a year.
But you created that chart.
I did. That's why I like it.
Yeah, it's a good chart. But it highlights the benefit of diversity. Which after the magic of compound interest is maybe the ninth miracle, the ninth wonder of the world. Compound interest is the eighth wonder.
What's the first wonder?
I don't know they're those ancient things.
Oh,
the seven wonders of the world. Then you've got compound interest, and then
this is something that you've created.
I made it up. Then no, I think Einstein may have said that compound interest is the eighth wonder of the world, or people attribute it to Einstein. And then I would say that diversification is the ninth wonder.
Mm. And that's it for the year. So thanks so much to everyone for listening in, and have a Merry Christmas and a Happy New Year. Thanks, Shane.
Thanks, Deanna.